on the dot, 4 o'clock. We're ready for our startup story session. And
Yes.
Thank you so much, Ashutosh, for joining in. So today is a very different and interesting session, a vital session for those as they're raising funds and they want to keep their teams happy with lots of stock options and ESOPs, etc., etc. So, Ashutosh, what can we expect today? And a small recap for the previous episodes, and then let's go for it.
Sure. Hello, everyone. Thank you, Vijetha sir, for again giving me this opportunity, and thank you also, Vidphone, for helping us host this on this platform. So, whatever we have covered so far, we have covered the team structures, how the founders, how do we match the founders. We have done sales and marketing, and we have talked about conflict resolutions. One thing that what it all leads to is the next step of discussions, which is like you have employees, you want to raise money, and what kind of vesting can be expected, and then that's where the whole equity part comes in. And what we have tried to do as an advanced session over here is that we have tried to demystify how startup equity works and how we can expect equity to flow in a startup, right? So that's the idea. What we can expect today is a little bit of simple explanations on what the common terminology is. We keep hearing preferred stocks, common stocks, stock options, what option actually means, right? And then the cliff and the vesting period and all that. And then we will also get into a little bit of an interactive demo. A friend of mine, we together put together a very interactive demo on how if you're raising money, how the entire structure changes. So we'll go through a lifespan of a startup, assuming it reaches till Series C. Right, so we'll assume that it's a good, well-doing startup, and then how it will interact. So, without boring everyone in basics, we'll start with the presentation. Please. Okay, I hope you can see my screen.
Yes, sir.
All right, sir. Okay. So when we're talking about equity, right? I mean, the whole point comes in as what an equity is. So as per the laws of any country, not just India, any other country, whenever a company is formed, there is like a number of shares which are taken out for the company, because eventually the idea behind it is that eventually one day this company would be traded in the stock markets, and it will go public, and then it will have equity for everyone, right? So every company has a stock option which is given, right? And that value is usually in terms of shares, and that share is what is defining the equity of the company. So, for instance, in India, when we start a company in India, let's say the CA decides that the worth of the company is 10 lakhs, right? So, at 1 rupee, at 1 rupee per share, the shares are released in the market. So that means that if there is only one founder, then they'll have like 10 lakh shares for their company, and likewise that share is distributed. The reason why it's important is because as we have more people, as we have founders, co-founders, employees, investors, every time we have more people, mentors and advisors as well, we have more people, a part of that share goes out in terms of equity. And that means that you are giving a part of that company. So for instance, when let's say two people start a company, and we'll keep that same example that we have 10 lakh shares, and the first thing that when two people start a company, or if we are hiring a founder or a co-founder, the most important thing is that we have to always value them, because the investors look at that, right? If let's say a company started where one founder, the CEO of the company, has 90% of the stocks, and the other one has like 10%, the investor directly won't be interested, because to him or to the investor, it'll feel that the other person is not contributing that much, right? So it's important to have a very good balance between the at least the co-founders and then how their equity is split, right? And the 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 distribution of the equity is never about who's giving the better idea. It's not like we start a company. Our first example, right, the drone company. We start about we go into the drone company. It's not like who's giving the best idea on let's put a camera on this, let's put speakers on this. It's not about that. The equity distribution is always about the execution. If we have a co-founder who is on the sales side, if we have another co-founder who's on the tech side, so who's contributing much, right? The sales guy obviously initially won't be contributing that much, but the tech guy would be. And then once the tech product is ready, then the sales guy takes over. Then it's more of a sales cycle than a tech cycle. So that doesn't mean that the salesperson or the sales co-founder gets a lesser equity because they are eventually driving the sale. So the equity distribution is all about execution. It's not about ideas. And I say this, with a little bit of pain and with a little bit of disdain that when I see equity distributions among founders in India, that's one area where I see it's very lacking. Two friends start a company, they divide the equity equally, then they get another guy, and then they give him 5%. Right. So the immediate question, one, like I said, will come from the investor, and the investor will say, why is this guy getting 5%? That means that the contribution of this guy, as compared to the founders, is very less, or maybe close to negligible, right? And then that has a negative impact. And similarly, when we're talking about like somebody getting a lesser equity, it also doubts their execution. It also doubts their what is the role, right? So and it's very hard to put a number to a role, and that's why we always say that at least when it comes to the equity split, it should be close to the equal, right? I mean, it should never be equal, right? I mean, that's another point, that it should never be equal, but it should be very close to equal in when it comes to the founding members. And it should never be equal is because somebody has to make the judgment, right? Somebody has to make a decision when it comes to the way forward or the planning. If both founders have 50% equity, it becomes a little bit difficult there, right? And then who's the decision maker? So the decision maker is the one who has more equity, right? At least on paper. So the equity split should be very close to equal, but not equal when it comes to founders. Great. So now that we have talked about founders, now we have talked about like how founder equity should be working, right? Then the next question comes is what is the equity for the employees? And this slide goes both ways. It's not just for the founders who are looking for employees. It's also for the employees who are looking at founders, right? It is a very well-known fact, and people say that, especially from an employee perspective, it's a very well-known fact that a lot of people say that startup equity doesn't mean anything, right? And it may be true for like 80 to 90% of the companies who are not publicly traded, or they've not made an exit yet, right? But in a startup which is doing well, which has a revenue, that equity really means something, right? That equity means that this company is doing well, and this company has a valuation which is worth talking about, right? And in that case, from a founder's perspective, when we get an employee and then we are assigning some equity to that person, it gets them directly invested. Right? If Obviously, it also means that at the starting stages of the company, we don't have enough money to pay or to compare the salaries of a MNC or a government job, or for that matter, another net worth startup, right? So we want to look for people to whom we can pay less money, but at the same time give a chunk of our company. Right? And that chunk of the company is in terms of three different forms. One is stock grants, the other is the stock options, and then the third is the stock warrants. The most common one in India is obviously stock options, which is ESOPs. I'll just have a brief word on what stock grants are. So grants are basically the equity that is given, immediately. Not like immediately, but it's executed the same way as the execution happens for the founders, right? Stock options, which we all know, is an option, and options have an expiry date. So that option basically works in terms of the vesting. So vesting is basically when the employee can obtain a stock, and I'll go a little bit more detail into this because this concept um, is very less talked about, and it's something which is very important. Is what is a cliff and a vesting period? So cliff is usually the time where the employee is in the company where they don't get any stock. So let's say we are saying that a company has a 1 year cliff and 3 year vesting period for a 5% equity. Right? So that means if the employee leaves the company before 1 year, they will not get anything. And that is the cliff period. Right? So in the cliff period, the employee doesn't get anything. After 1 year, their vesting period starts. Vesting period is where they are able to get some part of the equity that they were promised. So let's say if they're promised 5% of equity, and then the vesting period is 2 years, that means every 6 months they'll get some part of the equity, right? Which is per the contract. And usually the contract is that every 6 months you get like 25% of the company, right? So that means that when this whole process starts, and then they were supposed to get 5% of equity, then after the first 6 months they complete, they'll get 1.25%. Then after another 6 months, they'll get another 1.25, making it 2.5%. Right? And likewise, it will go on till they are able to complete 2 years. Once they complete 2 years, that means that they own that equity, right? Which obviously has more value when the exits happen or when the liquidation happens. But this is very important to understand when you're signing up your ESOPs, and when you're creating ESOPs also. So from an employer's perspective, um, uh, employers tend to be a little more greedy. They tend to put like a 3 year cliff period and 2 year vesting period, saying that you're invested in the company for 5 years, right? I don't think that really makes sense, right? From a personal perspective, the cliff period should also be in such a way that you can trust your employees. Longer cliff period means that you're holding the employee for 3 years without giving them uh, any equity. There is nothing wrong with it. There's nothing legally binding that people cannot do that, but it does come as a dark pattern. It's something that should not be done, right? The cliff period at least should be smaller. The vesting period can be more, right? I mean, because that's how we build the trust with the employees. We start with maybe a 3 year vesting period, right? So that means that if they're getting 5% of the company, so they're waiting for some time before the vesting happens, right? But the cliff should be smaller. The cliff is basically what ensures the trust between two people, right? And then the final question is like how much equity to give. And this is of course not a rule of thumb, but this is something that I follow personally. I look at what is the role of that person in the company versus the risk, and then I add seniority to it. So it's like a weighted measure that I use, and it's a very simple philosophy that I have, because if we are hiring like engineers, so they'll have like their role percentage is about like 0.8%. If you're hiring designers, then it's something else. And then if you're hiring someone who's like on the sales side, then it's again like 0.8%. Marketing is about 0.6%. So something like that, right? So that's what a role is. Risk is, it's on a scale, right? So if we see that if we then when we read the resume, we see that they're switching jobs quite frequently, then the risk factor increases. But if we have seen that a person has been in the company for a long period of time, then they're more stable in terms of their approach, and then they have a lower risk, right? and then you add that to seniority, right? So that's on the basis of that only I decide equity, like how much equity is given to a person. Happy to explore this more with anyone who wants to talk about it and then want to see this in action. But it's a very simple mathematics that I use. Happy to share like how this happens as well. Finally, now that we have talked about like how equity works for founders and then how equity works for employees, there are like a lot of common terms that we want to talk about. The most common being common versus preferred stock. Right? Preferred stocks or preferential stocks are something that are given, I would not say immediately, but they have more preference, right? So let's say if we go for an exit, if the startup goes for an exit, or goes for solvency, or one of the founding investors or members are leaving, uh, preferred stock is the one which is given out first, right? And the second part is that the other thing is the common stock. So common stocks itself can also have multiple divisions, and it's always um, advised that you have more than one type of common stock. As the company gets more and more investments, the common stocks should also have like divisions, like common stocks A and common stocks B, which means that people who have common stocks A will have more value in the company than common stock B, right? And that also depends on the age that they have been with the company and then the time they have spent with the company, right? The second part is the valuation. I think this is most common that everyone knows about is what is the worth of the startup, right? And there are two ways to look at valuation of a company. The one way is when the company has started. That means that at that point they don't have a revenue, right? So what is the value of the company? Right? So that's initially decided by the investors or the founders and whoever is the shareholder, right? And it has very standard models, right? So when we discuss like in further sessions, when we talk about like investments and then investors, and then we talk about like how what kind of models we follow. So I'll touch upon this in details, but there are like other models like discount factor based models, and there is a single entity based model. So there are quite a few investor models that are available, right? A lot of people sometimes go straight up. So if you go to a lot of investors right now, where you're an early stage startup, they blankly say maybe I'll give you 500,000 for 10% equity flat out, right? So there is no model behind it. It's something that they see as a way to devalue their risk, right? Because investments are also driven by portfolios. So when investors invest into a company, they're not just looking at one company. They're looking at like 5 or 6 companies that they've built in their portfolio, right? So even if they invest in a one early stage company, they try to hedge that risk against others. So then they have like sometimes very flat models that you can take. They'll take 10% of the company at 500K investment, right? So it's decided in very different ways, but at each stage of the revenue, or the stage of the company when it's making revenue, there is a different valuation model that is used to evaluate. And then what is a pre-money and a post-money, or post-money, right? Again, this is something that we don't talk about that often, but there's a difference between what is a pre-money valuation versus a post-money valuation, right? And it's a very simple concept, right? If you're raising money right now, let's say if we want to raise a seed round of 2 million at an 8 million valuation, so that's a 8 million is a pre-money valuation because we have not received that 2 million yet, right? So we are asking for money from an investor at this valuation. That means it's a pre-money valuation. And then let's say we are given 2 million, right? So we achieve 2 million. So then post-money is pre-money plus the money raised. That means our pre-money valuation was 8 million. We raised 2 million. So now our post-money valuation is 10 million. Right? Simple concept, very simple concept, and we'll go a little bit into more details on like when we go interactive about it. But these are the concepts that are most common. Just one more thing that I'd like to touch when we're talking about employees and then their stock options. The stock options themselves have different stages at every stage of investment. So it's not like, when we decide on the ESOPs at the first level, there's a certain equity that we are reserving for that stock option, right? But when we are raising another round, that means that there is more dilution happening. So at that time, we can change the stock options. We can have another layer of stock options, right? So we're gonna touch up on that, right? And then we'll see how it works. But it's always advisable to have like multiple layers of ESOPs also. All right. So now we'll make it interactive with the help of a demo. And I'll not take much time on this. We'll just quickly go through the demo and we'll see how it works. Okay. Okay. So we are taking one example, straightforward example. There are two founders in the company, one with 60% equity, and then the other one is with a 40% equity, right? Now we want to, we want to raise investment. We go to raise seed investment, and going back to our example, so we want to raise 8 million, right? We want to raise 2 million at an 8 million pre-money valuation, right? So now you can see that this was the initial graph, right? There was no valuation. When we come here, we'll see that then the investor, takes 20% equity in the company, right, for that valuation, right? And then so when an investor comes in and then he or she is taking 20% of the company, it goes 20% goes from both accounts, right? So that's something that people think that when an investment happens, there is a reserved fund for investment. There is no such thing as a reserved fund for investment. When you open a company, if there are two people, they want to see the government wants to see the split between two people. It shouldn't be that there's two people and there's a reserve for the third person. There is no such thing. So when the 20% goes, it goes from both accounts, right? So it's a percentage, so it goes from both accounts. Right? So that's how it will look like. So when an investor comes in, their equity stake is here, so they take 20% of the company, and then we initially started at an 8 million pre-money round, right? And then our money raise was 2 million, and then we raised to post money 10 million. Now we are at a point where we want to hire people, right? I've always said that when we talked about teams, when we talked about co-founders, is that if we can do work ourselves, we should do the work ourselves, right? And then the equity split always comes later in terms of options, right? But if you have raised money, that means that money is raised against some commitments which were promised to the investors, some commitments which were promised to the shareholders and the stakeholders, right? So that means that to meet those commitments, we need to hire people, right? Again, when we have raised, $2 million, it's a lot of money, but that money has to go across like money things. It has to go across infrastructure. It has to go across, HR, consulting, maybe buying patents, maybe filing for patents. So there's very limited amount that we can, pay to employees, right? Long-term employees. So to circumvent that, we would have equities, right? So we will put an equity, right? And let's say we keep a total of 15% equity, right? Now this equity is usually always post financing, which means that at this stage we are not keeping anything. Once we have received the investment, that at that time we are putting the equity, which also means that my post money, and this is very important, still stays the same, right? If we look at earlier, my post money was $10 million, and even now my post money still stays the same. What is happening is that my initial valuation, which was 8 million, is changing to 6.5 because I've kept a 15% for a 1 million, 1.5 million valuation, right? So this is very important, right? So when a stock option is been given, it doesn't change the bottom line for the post money valuation. It is always from the pre money valuation That's where we are keeping the option pool. And this option pool is for not just employees, but it's also for advisors and mentors, whoever we get on, right? Whoever we feel that is a person that we need to keep, right? We can keep that. Right? Okay. So at this point, what will also happen is that investors will stop looking at percentages. They would see that there is more value in seeing the worth of the company, right? So that's why if we talk about Flipkart, if we talk about Paytm and others, right? We look at their dollar amount. We stop looking at their percentage amount, right? So if you look at the percentage amount, between the founders, it was like maybe 50-50, maybe 40-60, 70-30, whatever it is, right? But once the investor comes in, then there's a real value associated with it, right? So once the real value is associated with it, then the company's net worth is 10 million, right? And then the employees who will come in now, that pool will come in, their worth is about 1.5. So at this point, we stop talking in terms of percentages. We stay in more in terms of the actual dollar amount. There is nothing wrong with it, right? So we can keep percentages, and that's what I mentioned here, right? So we can keep like percentage of value, but it makes sense that we talk in terms of real dollar. Right? So now we are at a point where we are going to raise Series A. Right? Things become slightly more simpler here, but what happens is that the dilution of the company starts to go more, right? So when we are talking about like a Series A, right? This is the growth for Series A, and for comparison sakes, there is the growth here, which is for seed, right? So at this point, there are multiple things that can happen. It's possible that the same investor will invest in the company again. It's also possible that we'll get new investors, and it's also possible that the same investor is putting more money, right? So that means that we have, if I zoom it a little bit, so if we see that we already have like a 2 million investment, which is here, and then we are, let's say, we want to raise like $5 million, right? So at this point, one more thing that will happen is that the valuation metrics that the investors use or the VCs use will be in real terms, right? So whether it's like, they're using discount factors or whatever they're using, right? So this will be in real terms. This will be, the real valuation of the company based on the revenue that was made, based on, the profit that was achieved and stuff like that, right? So what we see in like annual reports and all, so that will all play a part in this, and then we'll get that, valuation, right? One more thing that will happen here is that we will also release. So let's say if we are, releasing it at a 20 million pre-money valuation, we will at this point again have new set of stock options. So again, our 20 million will split into, let's say if we do 15%, so it will split into $16.2 million as a pre-money valuation, and the options will be at 3.7, which we can also see here. In this interactive graph, we try to put this, right? So we have like the founders, we also have the first investment, and we have the first pool of options from the first round, right? The seed round, right? Or our first set of employees. Obviously, people who stick with us longer, they get more benefits out of it, right? So that's the option pool. And then this is the option pool for the series round, like this Series A round or the second round, right? And likewise, we have this. Right? So similarly, when we are going with Series B, we have the same structure. What will happen at later stages, whether it's Series B, Series C, and we'll talk a little bit about the exit stage also, is that the option pool will start to reduce. So let's say, this is just an example. In the seed and the Series A, we kept it at like 15%. Now what we'll do is that we'll do it at like maybe 10%. And maybe when we are doing it Series C, where the company has become very big, and then there are people, but we still want to give out stocks. For instance, if you look at Slack or even AWS for that matter, both these companies, at least Slack has done Series F or Series E. But even if you're like you join the company, you still get one little bit of stock option, right? So some companies still want to do it, and then they keep one part of their option pool for specifically for that. So just going further in this example, if we are raising another round, at this point, our the raise that we are doing is bigger, and then the equity dilutions will start to happen. We may want to issue more stocks, right? So the entire stock breakage will happen, keeping the equity same. Then we do that, and then here what I've done is we have put like a 5% post financing stock options, right? So we keep doing that, right? And then I'll not talk about down rounds, so that we'll cover in the investment slide, right? So when we are doing an exit, right, this is where the crux of it all is, right? This is where the people make money, right? This is where if somebody who's an employee who wants to know how much money they'll make, right? Or if I am a co-founder, right, I have 40% of the company when I started. Where do I stand now when we do the exit, right? So this table shows how that will look like. Right? If we had started at 60% and 40%, after all the equity rollouts, after all the share distributions and dilutions, if the company exits at this point, founder one will make close to like 21 million, founder two will make close to like 14. And this is just like very random numbers, right? So, but you can also see how the employees will make money, right? So if employees were in the first pool, they'd obviously make about close to 8.1. But if you see the return on the investment, this is the key part here, right? So they'll be like on the 441% of where they started. Right? And same goes for the investors also. People who invested first in the company, they're investing. They're taking a risk, so high risk, high rewards, right? That does work in startups, right? So they'll be making most rewards, and obviously they can also be making part of the pie here and here and here also, which means that they can be reinvesting in other rounds also, and they can be supporting the other rounds. So that means that the key crux of it will be more than what it is right now. But usually this is how it will go, and then this is how the structure will look like. Right? So I'll stop here. Maybe once we do the investment one, we will cover it again in a little bit more detail. And but I just wanted to talk about like how the investments will look like, and how we are going to you know how the equity and the investments are intertwined and how they'll be working together.
Thank you so much, Ashutosh. And can you come back on screen? I don't see you on screen.
Oh, you don't see me. Oh, sorry.
No, I got scared. Like, is this an alien?
All right. Okay.
So Ashutosh, I mean, you have given a very good technical overview on this. Okay. Now let us come to the nitty-gritty, right? See, I mean, I'm coming to your statement that you were saying, sometimes Indian founders at times, and also they're not able to really quantify, explain why they're giving or not giving equity to founders, to employees and all. But I always hear from large corporates also. They make sure that critical people, whatever a very very small tiny sliver of equity and ESOPs is always given, because that is something that will motivate them, help them to stay grounded towards the company and work very very hard. And also it makes sure that the employees or whatever, there's a sense of belonging. And also they stay because the more you stay, the more you get vested, right?
Yes.
So you have seen different communities, different countries. So what would be the input as to how can you leverage the use of ESOPs and giving equity to help your organization grow? I mean, just coming to that very blunt thing, you need sales, you need growth. So how can you leverage ESOPs?
So again, when we do ESOPs, I mean, it has to be. It cannot be a blanket ESOP, right? For every employee, we cannot have like a blanket ESOP, and that's where that strategy of playing it with the risk and role, and then the experience of the startup founder becomes very handy, because you want to reward the people who you feel are contributing to the company the most, right? And that way you get more people. That's one part of it, right? But the second is that's only with the people who have been with you, who you've seen it work, right? But as you were saying, even corporates are doing this, where they're giving the ESOPs out, right? So if you join right now, they're giving ESOPs, and that ESOPs is purely based on the experience. That ESOP is purely based on let's say if I work for JP Morgan for like 10 years, right? So and then when I go to a new company, they'll say, hey, you know what, this guy stuck to this company for like 10 years, right? So maybe he wants a more reward, right? The risk is lower, the experience is high. Maybe this is a right person, right? So the way we structure the ESOPs is the way where we can incentivize it more, right? And then specifically for the salespeople, right? It's not just the ESOPs that matter. We need to give.
Interesting thought process and input that has come in from Ashutosh. This is something that gets talked about in the corridors, virtually and physically, through the founders. And some I would like to have some questions coming in on the chat, because we have Jagat as well here, and we have Chetak, and we have Sunil, and then we have Amar. So, guys, if anyone, and I've given the raise hand option. So, if anyone wants to join in till Ashutosh comes back, Jagat or anyone, please join in the conversation. So we can till Ashutosh comes back. Yeah. Oops. Jagat, sorry. I think I did something. I disconnected you by mistake. Can you just yeah. Okay. Yeah. Here you are. Thanks.
All good.
Yes.
I think Ashutosh will probably join us back.
Yeah. He'll join in. Okay. So, Jagat, what is your input on this? Because ESOPs will play a vital role for you as you're growing, as you're raising more funds, as more people join in. You have to use this as a tool to make people productive, to stay on, protect your IP, etc., etc. So, as a founder, what are your thoughts on this?
Absolutely. I think, really great session as usual by Ashutosh. Again, a lot of nice insights. I have a very simple view on this, right? I mean, the very first time when I started, or when we thought of starting a business, by default we did private limited, incorporated by shares. There's no question of any proprietorship, partnership, nothing. I think that's the power of companies, right? The whole point of the concept of shares and different people being able to co-own something is I think the great power of an enterprise, and that's what will always remain, right? I mean, that's the reason startups always you always start with nothing and then you end up with hopefully a lot, right? It's always a growing journey. So the fact that different people can come in at different points. Yeah, hi,
I thought dropped, so I thought I'll reconnect.
cool.
Yeah.
Hope it was easy to pop back in.
Yeah. Just got in. Yeah. Just got in. Jagat online. You just talk about how can early stage founders, as they're raising funding, they're bringing in critical employees or retaining critical talent. All right, these are some of the things that will matter in the longer run. So, Ashutosh, that's a conversation that I thought both of you could continue having. Yeah, so that's the deal. So, Jagat, continue, and you can have this. Let's get in Ashutosh into the talk.
Yeah. I was just sharing Ashutosh with Vijetha also. See, that is the beauty of companies, right? The whole idea of having equity and shares and being able to co-own something with people is I think, the beauty of companies. Nothing else, right from the beginning, even when I thought of starting business, luckily I had my dad who kind of, gave me the structure very early on to start a private limited and move forward. It's easy to get into a proprietorship or a partnership kind of firm. Then, I feel you don't think as a corporation, and it's important. I think the whole concept of equity comes in with, when startups create private limited companies. And that's the beauty of companies, right? I was just saying, I think that's why you'll always have startups that start with nothing. People put their sweat equity in, build up the equity, and they will always challenge large companies. And that's the nature of how corporations are built, right? It's one of the few things, apart from marriage, where I think two people or more can share something, right? It's very rare that you find such a structure. So it's really amazing. Really, people have, I think, British probably started the whole concept, and I think equity really comes from there, right? I think the whole fundamental idea is to be appreciated. The fact that you can co-own such a large enterprise together, and people may be completely different, different views, but for the case of this company, for this objective, you can come together, right? That's powerful.
Right. And I agree. And what I was saying while I lost the connection was that when it comes to equity, right? So ESOPs is like one option, but at the same time, you also reward the employees, right? So let's say sales, right? So it's a little more incentivized than just ESOPs, right? So they do get like part of the company, but they may also get like part of the deal, right? Like how corporates are doing, right? So if they bring more business to the company, they do get a cut of that, right? And so that motivates them further, right? So that motivates them to get even more invested in the company, right? And what also happens is that when you're raising more rounds, so you can change the ESOP structure, right? So you can give them more equity, and that's how like Amazon works, right? So AWS, every time, let's say you complete 2-3 years where you have completed your cliff and the vesting period, right? So they give you an option to make more equity, right? So you are invested for a few more years, but then you're making more money, right? So it's not like done one scrap deal, right? So it's like a evolution process where it's evolving, and then based on how people are working, you react to that, and then you give them more rewards on the basis of that.
I think absolutely. I think, in fact, I was having a conversation. I think Sanjay Mehta of 100x. I think he was there. Very interesting because they have very radical ways of investing itself. I would say, like the iSafe notes. I think they're the only guys doing it really openly in India. It's I believe a very very common thing outside, right?
Yes.
And you understand. I mean, convertible debt. And I asked even them the question that day when they were at the I remember at NASCOM. I think it was Vatsal, their CTO at that time, right? I think I asked him a question saying that isn't convertible debt still a debt that you still got to repay that in case you go belly up. It's still a debt, and that is something that we have to be very careful in India. And in the US, typically you have high net worth guys, they like write off 100K just like that. But in India, you have to be careful when you raise convertible debt, right? Come after you, like, hey, kahan gaya mera paisa, right? It's something to be very careful about. And I realize there's a new instrument that you can do. I mean, like for example, ESOP. The thing with sometimes with ESOP, why founders are thinking twice is because you're always giving away control also, right? Even in an ESOP pool, tomorrow the investors can try and acquire that ESOP and still take over more control of your company. So the idea is to financially incentivize the employees, but not necessarily to give up control. So certain instruments, I think Ashutosh, you may also be aware. I don't know the exact terminology now, but they have some structures where you can do that. Like they are not actually shares, but it's the equivalent of the financial return is equivalent, right? So it's very interesting. I mean, I think these are, as you said, work in progress in India.
And the thing is that it's a good problem to have, right? I mean, what now is we are at a cusp of where a lot of these new things will come, right? So we are seeing more and more HNIs who are not like your traditional HNIs, but you're seeing like US return or other places, or people who are making good amount of money here. So they have started to look at investments as a deal. So we are seeing the structure of the convertible notes and the debt also change, right? So some people are still looking at these new options, right? And phantom equity is just one of them, right? So, but it's a good way to look at it, right? So, I mean, if you think of the Indian traditional chain, right, it starts with like giving incentives, to salespeople, and then we came to a point where we said, okay, fine, we can do ESOPs, right? So now we can think of like phantom equity, right? So we can also think of equity plus incentives, and then we build up on top of that, right? So we have a point where we can split from the US general direction of thinking and then build our own, right? So we are at that point, and I think that's what we should be focusing on. Right?
Absolutely. I think always as ever evolving. If you can have structures where the ideal is quite simple, right? Everything has to vest. It has to be a win-win. These are some high levels, I think, of all deals, right? I think, with some of the biggest issues I know of, like guys who started in 2001, 2, 3, they were really large corporations. They started off in Bangalore. They raised money from ICICI Ventures and all that. And I know that the company went belly up because the three of them had almost equal equity, and it was a founder fight, and the whole company went like kind of bonkers, belly up, right? Because of that conflict. If there was a single majority shareholder there who didn't, and he didn't have to really worry about that side, there are sometimes it could have gone in the positive also, right? So these are the toughest parts. The moment you give out equity initially, and then there is no way to take it back. And suppose that guy changes his mind or something happens in the business. right? The whole business is at stake.
Yeah.
That's, I think, something that corporate law, they need to put something together, right? Because that's the
Yeah.
only fear I think everyone has. Like, we all start, everything's okay. Things go well, it's all good, right? If things go bad, then let the guys who are in the business able to run the company,
Right.
be able to buy back shares. But that's, how tough that is. I mean, no one's going to sell their shares, right? It's going to become and in the end, the employees and customers suffer the most. So
Yeah.
that's the biggest logjam for equity structures.
And
Those
just
kind of-
just to touch on that point is right. It's also the amount of rules and regulations you have to go through, right? So we love to talk about that part, in this startup stories. So we'll touch upon that also, right? So when we are talking about redistributing equity between founders and all, so you have to go through that whole legal process of SH4 shares, and then the share transfers, and then those legal agreements, and then it takes about 3 to 4 weeks, right? And if you have banking documents with them, then it's more work, right? So again, when it comes to all this, it's always good to have a legal person and a accounts person in your team who is well aware of what are the things that are required, right? I mean, whatever we have said so far is common knowledge that you'll get across every country, right? But then when you are actually doing it, is a totally different ball game altogether, right?
Your
So it's
context,
not yeah, it's not you log into a website, you add one more person, and bam, done, right? So it doesn't happen that way, right? So as always, all this is good to have on paper, but when you're doing it, always good to have one accounts and one legal person on their side, so that they can take care of all these things.
It's an expert job, no doubt about it. It has to be 100%. But I think at the end of it, all contracts, ESOP, I think number one thing is, when there is a trust, and in clauses in contracts, you will see the hardship. Right? I think that's a great clause.
Yes,
Ultimately, if everyone is working towards the right nature of the thing, things are in place, right? Only when people start thinking here and there, that's when the whole legal aspect really comes in. Otherwise, I think it's good to win with great structures. Great again as usual, Ashutosh. I mean, fantastic session. I think this is also very important. I think for people to understand equity, and because this is why people run startups, right? You don't get paid a salary when you start, so it's all about equity. Whether people have good understanding of it, a naive understanding of it, I think that's what separates the large companies from small companies. Right? So really wonderful. Thanks, Vijetha, also for hosting, and fantastic. Looking forward to more. Yeah, thanks.
Thank you so much, Jagat. Take care. Yeah, bye. Be generous with your ESOPs.
be generous and a little more trustworthy. Lesser cliff period, more vesting period.
Correct. Yeah. Of course. Yeah, that makes sense, doesn't it?
Yes.
Yeah, that makes a lot of sense. Yeah, because ultimately you are giving away a part of you.
Right.
Yeah, and you need people to be loyal, and you need people to work hard. And yes, anyone who brings in value has to be there, and they should be rewarded.
Yeah.
Very nice. So, Ashutosh, what are the, I mean, again, I'm going back to the fact that Silicon Valley, India, the comparisons, though it's not an apple to apple kind of comparison, but in terms of attitude and the way that they do it. But if one has also heard of some horror stories, people being mass fired just before the vesting happens, before an IPO. A lot of nonsense happens, right? So legally, how does an employee? I'm now going to the not from the startup founder, but someone who has been a great contributor, etc., etc. If you were part of a whatever different structure, how would you take care of yourself that way?
I mean, so I've witnessed and experienced some of these stories, right? So where you have invested in the company, and then as an employee or as a mentor, and then it gets acquired, and then suddenly the ESOPs goes for a toss, and then new regulations kicks in, and it's a very common story, right? That's why I don't know who said that, but somebody said this, that conventional wisdom says that startup equity is garbage, right? So and the reason for that is that this happens quite a bit, right? Fortunately, there are more rules and regulations in India that they are in US, right? So if you are if you are part of the company, right? So there is no startup law in India, but every law that is there is still covered under the Companies Act, right? So that means that if you've been mistreated in some way, and you can there is enough proof that you've been mistreated, so there is like a legal recourse around it, right? The US is slightly different because it gets very I mean, their ESOP agreements are also like 46 pages, right? So, so it gets very murky around where there's a gotcha and then they've got you, right? And which is why I keep saying, and I said this again today also, that we are at a cusp where we can do things better, right? So we've learned from the UK and US and other places, right? So we are at a place where we can do better, right? So we can always look at reforming our company's laws and making these startup laws, which are not just helpful for the founders, right? So we see, like the government is doing a lot in terms of pushing money, pushing, ease of doing business for startups, right? But there should be also for the startup employees, right? So people who are getting, employed by these startups, because obviously we are saying that 2030, in the next 10 years, the startups will be making more employment opportunities, will be creating more employment opportunities, right? So, but that employment opportunity is very different from your government or the corporate employment opportunity. So, how do we take care of those? So, there is like a lot of good laws here, and then it's always best to get in touch with a lawyer if this thing goes up for a toss, especially in India.
Interesting. So it works both ways, doesn't it,
It
Ashutosh?
works
Always.
both ways. Yes. Yeah. Yes. Yes. Yes.
Okay, great, great.
Yeah.
So see, when coming to what is the education that I mean? Look, you are very clear. Have a proper lawyer, have a proper thing. But if there was some self-education
Mm-hmm.
that a startup should know about, because it's one is of course the lawyer is there, but there are different things. What if you decide to set up a company or a subsidiary or list, say, sometime in say Singapore or US or
Mm-hmm.
whatever it is, Delaware listing, whatever, right?
Right.
So different rules, different. It's a different territory.
Yeah.
Right? Law of the land is very very different in different countries, etc., etc.
Mm-hmm.
So some insights or tips. Do you think that is important for the founder to know about, Ashutosh?
Yes, yes, absolutely. I'm glad you touched on that, right? So because I got two keywords from yours, like the US corporations and then also the subsidiary part, right? If you're setting up a subsidiary in India, right, it's a massive pain, right? Because let's say you're more operating in US, and then US is generating the money, and that's where you raise the funds, right? So obviously you'd be, and you have employees in India, so obviously you'd be transferring funds here, right? Every time you transfer money to your subsidiary, it has to be valuated. There's a commercial valuation that is attached to that, and then that valuation itself costs a lot of money, because that has to be done by like one of the big guns like KPMGs and EYs of the world, right? So there's a cost associated with that, right? And we went that route, and we found out that it was hurting our business, and then we went back and we spoke to, and this is after knowing a lot of things, right? So like I said, when you are actually operating, there is a lot of differences. When we went with the subsidiary route, we went directly. We didn't consult with the CA here. We just because both of the companies were ours, we set up the subsidiary rates. But when we transferred the money, immediately we had to go through the valuation part, right? So then we spoke to the CAs, and we realized that it won't make sense to do this, because even if you're transferring like 5 lakh rupees or 10 lakh rupees, you have to do that, right? So I'm really glad you touched on that, because as much as we can do self-education, right? When you look at these practical things, like if you Google right now, like setting up a subsidiary in India, no one will say that there's like this gotcha, right? They'll be like, great, this list of forms, you can fill it out, you can go somewhere and then submit it. But when you are actually doing it, you realize that there is like so much. I would not say pain, but there's so much like process to follow that comes around with it, that may or not work out with you. Right? And the same thing goes for setting up the company outside. You may feel that Singapore is a market, or UK is a market, and then US is a market. All of these countries are very good at attracting startups, right? Foreign startups. They'll say that UK you can set it up for like one sterling pound. US will say that $200 you can set it up, right? Singapore says something similar, right? But there's like a lot of things that goes around with that, right? So if you're starting a company just on your passport, it's very different than when you're starting a company because if you have a social security number over there, right? So reading about it is just one thing, but it's always good to, if not going to a lawyer, but always good to talk to somebody in the community who has done this, or post a question in the community, because you'll get a lot of these answers, right? And similarly, there are like a lot of legal websites also, where if you put these questions, you will get answers. People respond very quickly. But always, if we are doing the research, it has to be an interactive research, right? Just don't do reading and then feel that you've read everything. It's best to go back and then discuss it in a forum, in a community, in a group, so that there is more validation and more knowledge that you're getting, because these gotchas are not something that are discussed in any website. So it's the you'll always find like best ways to do it, but those best ways don't say how troublesome it could be.
Interesting, Ashutosh, very interesting. As always, when we're talking, time seems to fly, and I just realized that we're on the 56-minute mark now.
Mm.
So, Ashutosh, couple of things is that number one, how does
Mm.
this all link to the previous sessions, right? We
Mm.
talked about equity, we talked about legal part of it, we talked about building teams, hiring, etc., right? But
Mm.
ultimately, everyone comes to you because, as a job, yes, the top technology folks, they are the most wanted people. Every
Mm.
startup session or event that I talk to, everything, we want CTO, we want CTO, and these guys slog their asses off.
Mm.
Correct? They spend maybe at least the first 20-25 years of their life just studying before they can even get a rupee of earnings or whatever, right? Because there's a lot
Mm.
of study, a lot of technology building, and whatever. So how do you attract these people? How do you? It's okay. One is of course ESOPs, Ashutosh,
Mm.
but others also, in terms of the general principle of
Mm.
team bonding, etc., etc. Some things that you can talk about, if that
Mm.
makes sense.
So it's a it's a good question that it's linked to our previous sessions, because it always boils down to your story, right? It always boils down to how you have represented the startup. Even if you have talked about it in forum, let's say you go to a college and then you talk about your journey, your story, and a lot of times people want to see the transparency, right? When they're joining a company, especially when they're like interning at a company, right? Interns are usually better ways to hire someone, right? So when we are going over there, right, it's always good to be truthful and talk about your story, your journey, why it came to a point where you're starting this company, right? It helps in two ways. It helps in one, uh, getting people who are in the same mindset, maybe, right? Not a lot of people see when you're hiring for a startup, right? They know that you're not going to get the money, right? So you're not going to get the top dollar that maybe an Amazon is paying or a JP Morgan is paying, right? So why do they still want to stick with it, right? They want to stick with it because they love the story that you're talking about. Second is, if they're technologists, they love what you're building, right? So that also comes as part of the story, right? So they understand that it has all the right buzzwords. It's talking about like machine learning, it's talking about blockchain and all that, right? Third is, we want to move away a little bit from technology also, right? So when we are hiring, people from the sales or the finance side, right? So they love to see that there is a vision in the company. And that vision is coming from, like how the story is built, right? So as much as transparency, we talk to people, right? So that also gives the opportunity for other people to see, because uh, it's not just the employee stock options that they'd be ready for, right? So we've come to a point where we have like 80 startups per month, right? Registered 80 startups per month, right? So they're all doing the same thing, they're all going to the same colleges, they're all talking the same thing, right? So how does one person realize that I have to go to this company versus this company? And that's where the story comes in, that's where the transparency comes in. We talk about our struggles, we talk about like how we where we are, right? It sells technology, it sells sales, right? And it's also where you will find people who are not just in for the money, they're in for helping you build a bigger game, right? So it works both ways. I mean, you get more for it. So story is very important, right? So how you create and weave the story, and is where it will help you reach out to the investors as well, right? So when we come to a point when we have to go for investments, that's where also it helps because the investors also want to understand that part of the story. So maybe this is a good starting point to reach out and tell your story.
Interesting. Thank you so much, Ashutosh. I think that's very cleverly and very neatly sums up everything. I mean,
Mm.
building teams, growth, ESOPs, motivation,
Mm.
and as you're expanding, you need to have the right team with you, and you need to have them with you. Totally, the journey is never alone. It has to be together.
Yes.
So much appreciated. Looking forward to all the other sessions that we can cobble together.
Mhm.
And also, actually, some how-to sessions. I think people want to know about the new technologies, like
Mhm.
how to do more with blockchain. Because apart, of course, not about the cryptocurrency part. I'm
Mhm.
talking about the other applications that is possible, and
Mhm.
is there growth possible? Because I think we're going to be seeing a lot of major policy decisions also coming in, good or bad, whichever way. But that's
Mhm.
going to happen. And I think there's a lot of talk about Atmanirbhar and like again, see, we do talk about the fact that Indian companies difficult to work, they don't pay too much, they don't pay on time, all those kind of situations are there. But you build because looking at a potential problem and the solution that you can go there, and
Mhm.
maybe you can anywhere in the world. I'm sure that if you're good, customers will come to you. So we
Yeah.
keep that philosophy and that hope and inspiration going, isn't it, Ashutosh?
Yes, yes, absolutely, absolutely, and you're absolutely right that uh, when we're talking about here, right? So when we're talking about like startups and then the companies that we're building, right? So it's not just our growth, right? So it's not just our journey; it's also a journey of the people that we have hired,
Yeah,
right?
yeah.
So I mean, and I can say that personally because we started with like two people company and then we hired. Now we are at like close to 40 employees, right? But at the same time, yeah, that's what nobody wants to leave, right? So they all want to stay because we keep that transparency, we keep that level of growth in them, right? And I know that if one day some of these guys want to leave and they want to go out, they'd keep the same culture. They'd want to keep the same culture, right?
Hmm, hmm.
So you're leaving a mark, right? So it's a lot more than what you can expect, and that's what we are trying to do, right? So
Excellent, excellent. There are a lot of inspirational stories. Even the Zerodha story, without
yes,
any, they're still bootstrapped. There are
yes,
so many other wonderful organizations, and I think we should also look at the traditional businesses. Like you see how ID Fresh Foods, how they've
hmm,
evolved, and then the Haldirams. The Haldirams family is now an investor.
yeah.
I mean, like everyone loves Haldirams, and they're putting money into tech companies and nutrition companies, etc. So it's a wonderful place to be in. But yes, tough place, but there's a lot of inspiration and a lot of good stories. And thank you, Ashutosh, for a wonderful session. Always inspiring and always learning. Much
Thank you so
appreciated, sir.
much. Thank
Thank
you
you.
so much again for hosting this, and thank you, Vidphone, for this wonderful platform. We will come back again next week, right? So and then obviously you're doing a session tomorrow, and then we for
Yes, the
yes,
Startup Sunday,
Startup Sunday.
doesn't stop.
Yeah.
So this is for all the founders out there. We are doing this informal boardroom, couple of startups every time, founders only, of course. Just trying to understand what we can do for the ecosystem and community. That's all that matters. And let's keep doing some good work for each other as well. Thank you, everyone. Thank you, Ashutosh.
Thank you. Bye. Bye.
Cheers now. Take
Take
care,
care.
everyone. Bye bye.
Take care. Bye.